Hello and welcome to On Point, a series of webinars and podcasts of fresh thinking on the big topics for corporates and institutions. I'm Neil Parker, FX Markets Strategist at NatWest. In this episode of On Point, we're going to dive into how the Biden administration will affect UK and European businesses. Will the US roll back tariffs, reinstate strong dollar policies, and deliver economic transformation? How will the new administration support the transition to a greener economy? And can the US repair and restore diplomatic and trade relations with China, and do they want to? Most importantly, how could all this affect the average corporate in the UK and Europe, FX rates, and trade more generally? To help shed light on this, I'm joined by John Briggs, Global Head of Desk Strategy, and Brian Daingerfield, Head of G10 FX Strategy for the Americas at NatWest Markets. I'd like to start with the macro picture first, if I may. What are your thoughts regarding the US economy in 2021 and beyond, particularly given the fiscal stimulus bill that's before the Senate?
Yeah, thanks, Neil, and thanks for having us and for hosting this conversation. Our general outlook is a pretty positive one when it comes to the US. Indeed, we've been very much on board with what investors and markets have been enamored with, which is this idea of US and also UK, for that matter, exceptionalism, that the Anglo economies with vaccines and the nature of the service sectors reopening, that we're going to have a pretty strong release of pent-up demand this year. For the US specifically, not only though has our expectation for future data remained strong, but first quarter actually, despite the fact that we were worried about the second wave of virus coming through and before vaccinations came through, the data recently actually has been pretty strong enough to the point where, because we started off stronger than we expected, we originally were looking for 2021 growth in the US to be at 4%. Now we see it closer to 6%. And even with that being the case, which is a really strong revision up in just a few weeks, there's other, street houses out there that are even looking for larger than that. So there is an expectation that there's going to be strong release demand if we're definitely, within that camp. Now, granted, as you mentioned, some of that, when it comes to fiscal support, some of that better near-term data is due to support from the December aid package, which was passed before the end of the year, and a lot of those payments to individuals and support through unemployment insurance. And we do expect ongoing fiscal support from the current package. But that doesn't mean that because it's fiscally driven that it's any less important. I mean, the stimulus in the US and elsewhere, to be honest, was always intended to act as a bridge to get consumers to the other side of the pandemic and to the time we could reopen economies. It was just that bridge turned out to be a lot longer and needed a few more sections than we first anticipated, really kind of as we headed into the pandemic. So it's a good thing that this is being passed. We don't really think that a lot of the debate that's going on right now, that it's too much, is going to be a problem on the other side of it, when it either comes to debt or inflation, and we can talk about that later. And we do think that the current bill, which is in front of Congress, will get passed in the next couple weeks. The only real deadline, and we all know politicians do like to work to deadlines, is that March 14th, when the US unemployment insurance program, the extension of that ends. So that's really the only deadline they have, but it is a deadline that's pushing them to get this done. We don't know if it'll be the full 1.9, but we do expect it to be somewhere around 1.7, which is a pretty large package still at a time where markets are already optimistic, and as I said, we're revising up GDP. So U.S. consumers should continue to be well supported. Companies with U.S. exposure should feel pretty good about it. I would say it would feel great, but I do want to see vaccination progress continue, which would open up more travel and tourism. Hopefully my summer vacation plans to Europe will follow through. And also, we want to see this deal formally get over the line.
Excellent, thank you. And just to follow up on that, you mentioned you don't think that there are going to be inflation risks, but are there any risks around this bill in terms of potentially derailing the effect of it for the US economy? If there's no inflation risks, is there anything else that could dampen the impact of it?
So I think that when it comes to inflation risks, there's going to be concerns about that. It's just going to be hard to disprove that until later in the year. That kind of comes through the pipeline. So, I'm not an inflationist. I think globalization is a little on the retreat, but it still is going to remain. Technology, the ability for companies to pass on pricing as opposed to just building order backlogs, things. I think that customer loyalty, I do think there's a lot of dynamics that we've seen over the last 10 years that aren't going to exist. My biggest concern, I would say, as far as relating to the package, is it working into more of an overall concern about economic scarring that's occurred in the US and also in the UK, where there's an expectation that this package is going to add on to this huge demand push that's going to come through. But is it really going to be that easy to absorb in the US? The Fed has said that there's about 20 million workers that have either left the labor force or are underemployed, that will need to come back in. Is leisure, hospitality, restaurants, is that employment going to come back that strongly? I mean, yes, consumers are going to have more money than they otherwise would, but how many times can you go out to eat? Even though, look, I'm going to go out quite a bit once life reopens, but am I going to have breakfast, lunch, tea, dinner, after dinner? I mean, there's only so much of that service-led activities. How many haircuts can you get? You don't backlog haircuts, so I do worry a little bit that there's a little bit too much optimism right now, and that the bill is seen as stimulus as opposed to assistance. Because I think it is more assistance, again, to bridge that divide, and that it's certainly going to help GDP. It's better than we would have had without it, but that it viewed as a savior or a cure-all, I think, is a little bit too far, because I think there is going to be damage that does take some time to recover from.
Thank you. And that leads me neatly on to a question for Brian, which is obviously this stimulus bill is then potentially going to be followed by another stimulus bill later on. Will we expect the same momentum that we've seen behind this COVID-19 relief bill behind other fiscal plans? Biden's been very vocal on infrastructure and energy transformation spending, for example.
Yes, he absolutely has. And thank you very much for having me. I should say from the get-go that I was a bit more pessimistic on this first COVID bill in terms of how easy it has been to get through the House and Senate. And it looks pretty likely at this point that it's going to be passed in the coming weeks. And so even from that perspective, where I acknowledge I was a bit more pessimistic than maybe I should have been on this first round bill, I feel more comfortable saying that we should be pessimistic about especially the speed, but also the ability to get the second bill through the Congress. There's a couple of things to consider here. First is the difference in urgency is really important. That this first stimulus bill, this first 1.9 trillion tranche, is really about getting stimulus money to Americans and to American businesses and to vaccination efforts as quickly as possible. The desire to nitpick over the details, the specifics of that, seems to be overwhelmed by the desire to try and get money to struggling Americans as quickly as possible. And that alone, I think, is putting pressure on some moderate Democrats to sort of put aside their smaller quabbles and try and get a bill out quickly, and to really take advantage of the fact that they won the Senate majority, albeit very narrowly, in January. That same level of urgency probably won't exist for the second bill for a few reasons. Number one, it's simply just not the COVID stimulus, and so maybe some more room for scrutiny. But at the same time, that bill looks like it's going to be very large and very all-encompassing. It looks like, we'll learn more about that bill relatively soon. It's my expectation that Biden will deliver what is essentially a State of the Union speech sometime this month, in which he will outline that plan. But that's probably going to be very wide-reaching, not just infrastructure, but also potentially changes in corporate tax rates. A lot of climate initiatives may find their way in there. And the more wide-reaching the bill becomes, the more difficult it will be to get a consensus around it. So you mentioned energy as an example, and I think that's a perfect thing to point out, because you do have Democratic senators from states where natural resource production is significant. You talk about someone like Joe Manchin from West Virginia, coal production, for example. You've got John Tester from Montana with mining. And so, if you have infrastructure wrapped in with climate, is the climate too aggressive in order to get people on board with the infrastructure? What about tax increases? There are a number of conservative Democrats like Kristen Sinema from Arizona who may not vote for any corporate tax increases as part of that bill. So I think from an urgency perspective and from a scope perspective, I think it's right to assume that second bill is going to take more time, and it's going to be more difficult to get to that 50 vote threshold that would be needed to pass the Senate in a reconciliation effort.
Okay, so it may be that Biden not only faces potentially having to reduce his plans for spending, but he may also be forced to borrow more than raise taxes. Would that be a reasonable synopsis?
I would think so. I think what's likely is that you would end up with a bill that is not as ambitious and maybe more targeted. And so if the overall size of the package is smaller, but there are no tax increases, then from that perspective, the impact might not be the same. So for example, if there's a $2 trillion bill with 500 billion worth of revenue raisers compared to a 1.5 without, that can end up netting out. But right now, the package that he's looking for looks like it's a bit too ambitious to get over the line with the Senate majority as narrow as it is. Just as a reminder, the Senate is held by Democrats with a 50-50 split. And there won't be any Republicans who support the bill because of the way it's being passed. The reconciliation process is specifically designed to shut Republicans out of the conversation. They hate that. Even if they supported this bill, they wouldn't vote for it on principle. And so you would need all 50 Senate Democrats. And the truth about it is similar to the Republican Party. You run the gamut from very progressive senators like Bernie Sanders, Elizabeth Warren on one side, to very conservative Democrats who you might as well consider Republicans in Democratic clothing. And so meeting all of those constituencies within the Senate to get one bill on a bill that large and that wide reaching, I think is going to be more difficult. And the urgency premium just won't be there like it is now.
Yeah, that I think that's very interesting because, and we will get onto this, that may have implications for the dollar. But let's shift to the international picture and back to you, John. What do you think a Biden administration brings in terms of the UK and Europe? Will they row back on tariffs? Will they reinstate the strong dollar policy, as two examples?
Yeah, so for those on this call, I think there's good news, but also bad news. The good news is that the Biden administration is going to take a much more principled and alliance-based approach to many policies, kind of a harken back to the Obama days. And global economic policy is going to be one of them. And they're going to see cooperation along economic lines, as we've seen like Russia and Iran on the geopolitical front. So there's going to be a lot more cooperation. He's pro-EU, he's pro-NATO, and et cetera. The bad news for Europe, though, is that, despite in January, the U.S. held off from, in response to digital taxes and the issues with France, the Biden administration said it wouldn't be ending tariffs on European wine, cheese, and other food goods. I was actually a little surprised that there wasn't more of a, fig leaf to the EU about railing that back. I mean, I know it's related to issues around Boeing and Airbus, so maybe there's a domestic versus international political calculus there. But it looks like those are staying in place for now. But I will say that new tariffs or disagreements look likely to, not be on the cards. Holding on pre-existing ones, is one thing. But I don't think that, that they're anything beyond like really localized or, things that process through international institutions and, the existing structures, which take time, so I think that there's not going to be surprise. Policy by tweet is not going to be something that happens here, especially when it comes to the UK and Europe. But on Europe, rolling back some of those tariffs looks like it's going to take a little bit longer, a little bit harder, though, again, I don't think new tariffs or disagreements are going to be escalated like they were under the Trump administration. For the UK, the bad news is that it's back of the queue for a new deal. Status quo is likely to remain for a while. The administration on a trade policy front has its attention squarely set on China, and the rest of the administration is more focused on domestic issues. There's the priority, which is, to be fair for all nations, which was get our economies going again. They're focusing on the fiscal bill. They're trying to get vaccines out. It's not to say that an administration can't, as we say, walk and chew gum at the same time, but there's a lot of priorities here that are being whether you're looking at narrowly in the trade front with them pointing, trying to get more done towards China, or broadly as far as the administration objectives, a trade deal with the UK, unfortunately, is just not that high on the list. So I think that it'll be a cooperative one. I think the negotiations would progress pretty well, but it's just not, on the top of the list. So it could take a little bit of time. And so, if I was thinking at it from the standpoint of, some of our audience there in the UK, I would just kind of expect more of the same, for probably quite a while here.
Okay. I'm going to throw a bit of a hand grenade in here. Would it have been materially different under Trump, do you think, if he'd have won a second term?
Well, I think that they probably would have had a little bit more up the priority given, just the relationship with Boris Johnson and Trump has the people that he likes and doesn't like. There were probably, there would have been continued issues with China, true. But I feel like that it would still be, down the list of priorities, but it would have been further up the queue. That doesn't mean that the result would be something that would be more favorable for the UK. That's the thing. You might have more certainty, but a less favorable result. I think the deal down the road, it might take longer to get to, but will probably be more balanced under a Biden administration. So it depends on kind of what you want. Do you want the certainty sooner, but you might not like the outcome, or do you have the kind of status quo and uncertainty longer, but with a better outcome? That's kind of how I feel like the two administrations would have been different.
I think that's very useful in terms of that a lot of people perceived in Europe and in the UK that there was a much greater likelihood of a deal being done much more quickly. But I think the reality may well have proven different on that. So back to you, Brian. Can the US repair and restore diplomatic and trade relations with China? And do they want to? Does a UK or European corporate need to worry about spillover to our shores via the Chinese renminbi?
So turning to China here, I think it's very clear that the Biden administration is not looking for a reset in relations with China. They've begun their administration on a fairly combative note, whether it comes to Taiwan. It's clear that from pretty much all of the appointments made to the cabinet, comments from Treasury Secretary Yellen, comments from the USTR nominee Catherine Tai, have all been very clear that China is a strategic competitor which needs to sort of be challenged by the administration. So we're not getting de-escalation. I think that's very clear. Something kind of to piggyback on what John was saying about the EU, but it's also true for China. The Biden camp on the campaign trail, they criticized the Trump administration for their policies of being a bit too, all-encompassing, a little bit too maybe irrational, a little too quick to action without really, being selective in terms of what the impact might be. But that doesn't mean that they're not using it conveniently. They're not in a hurry to take off the tariffs that Trump had put on. And that's because I think the Biden administration sees it as a relatively convenient thing that Trump gets the blame for putting the tariffs on, but they get to have the protectionist benefit of leaving them on. So Biden and the Democrats are not the party of free trade. They're not the party of pro-business free trade utopia. And I think that's going to be clear across several different sectors, including China. Now, the big change in the China policy is probably predictability and the scope in terms of using our alliances to try and work together on China rather than the US going it alone. But I think it's going to be difficult. I think Biden's going to run into challenges in terms of how can you get the US alliances, sort of the alliance of Western democracies, together united in one policy against China, because different economies have different goals. And if you recall, at the end of last year, the EU signed a comprehensive investment agreement with China after some reportedly last-minute concessions by China. I don't think it's a surprise, or I don't think it's a coincidence, I should say, that China made some major concessions to Europe to secure an investment deal, essentially their phase one with Europe, in the 2 months between when Biden won before he was inaugurated. That feels to me like a step by China to try and sort of preempt this possible coming together of the US and Europe against China. And so I think Biden might have some trouble in the execution of bringing together the US and Europe to work jointly on policy with China. So in total, we don't think you're going to get de-escalation. I think it's going to be a drawn out process. It might be difficult it doesn't mean you're going to see escalation. So from the perspective of the yuan and China's economy, that economy has performed very well in the aftermath of COVID. As the pandemic recovery has continued, their COVID management has been, best in class, really, and it really shows in the growth outlook of both China and of the China-linked economies across Asia. Our measure of stress in the Chinese economy, combination of bond yields, equities, commodities, and also the currency, is at relatively low levels. In fact, it's at multi-year lows in terms of the amount of stress overall. So from that perspective, we don't think China is a near-term risk. If anything, I think the Chinese currency can probably strengthen a little bit further. So we don't think escalation is going to be a near-term risk, but de-escalation certainly is not in the cards. It's not a reset of relations under Biden.
Just as a follow-up on that, but shifting the emphasis to the Middle East, do you have any thoughts with regard to recent events and what that might mean for US relations and FX?
Well, sort of a couple of things. Right now, the big one that I think we're all watching from the oil perspective is really twofold. Is one, the US relationship with Saudi Arabia, and two, what's the future of the JCPOA, also known as the Iran deal. From the Saudi perspective, there are some pretty high profile headlines from the US that Biden is not going to try and escalate any sort of action against Saudi Arabia for its role in the death of the journalist Khashoggi in Turkey. How does that impact the security relationship? It's very clear that the Trump administration had a fairly cordial relationship with the Saudi regime. And the Biden administration is expected to have a chillier relationship with them. And as a result, the idea of some sort of shadow coordination between Trump and OPEC, which was one of the themes of the oil market for the past couple of years, certainly wouldn't happen under Biden. So that's certainly one thing to watch from an FX perspective. I think that comes through via oil is how does Saudi Arabia, which is really they're sort of the major player from the OPEC perspective, how does that change in relationship impact their willingness to either pump oil more aggressively to try and take back market share, lower prices, or pull back on production in order to boost oil prices? That's something that's probably going to play out over time. I don't think that's a near-term concern simply because oil developments are so far above and beyond Saudi and US politics, right? Oil has been surging. The other factor is Iran. Right now, Iranian exports of oil are about 300 million barrels per day. That could rise as much as 2.5 million barrels per day if Iran were to get back to the pre-sanctioned state. So from a perspective of how much oil could come back to the market, you're talking about 2 million barrels per day. Oil demand is roughly 100 million barrels per day globally. And so that's around 2% as a rough math. So from that perspective, the possibility of Iran coming back to the market if sanctions were to be reduced is potentially significant. And I think that's something that is going to be a headwind potentially going down the road for oil prices. Certainly, you've had a very strong month. Is that something that's going to come back relatively soon? I don't think so. Clearly, the Biden administration is open for renegotiations. The headlines on this have not been good at the start of the dawn of the administration. They've had skirmishes in the region. The language has not been particularly constructive. But that's certainly something that's going to hang over energy prices, is this possibility that if you were to get a surprise momentum on a deal, that could bring with it more oil production. So from an FX perspective, those are the two that we're watching most closely because of their impact on oil prices and some of the oil-linked currencies.
And John, just coming back to you very briefly on climate and China has been mentioned. What about climate domestically? Just going back to the Biden administration, is there any other points you wanted to make with regard to that?
Yeah, definitely, because I do think that there is some headwinds that could come on the climate side when I'm thinking about how optimistic we are in the US and how well we think things are going to go. Probably more down the road. But I think the question on climate is best answered twofold. First, Brian talked about Biden's infrastructure bill, how much he spends on pushing new spending on green infrastructure. And that's going to be a tough balance between making the left happy and keeping moderate Democrats on board. Just to repeat the point, Senator Manchin in West Virginia, he's a Democrat, but it's a Republican state that Trump won by 17 points and has a huge coal industry. So I agree with Brian that I think that's going to be really tricky to get through. And the point is, though, that the less that he can get done in legislation, let's just say that he's able to get very little done on his climate agenda in the next bill. It's slimmed down, it's traditional infrastructure, building bridges and building tunnels and that kind of thing. The less he gets done in legislation, the more he'll have to get done in regulation. So, DC insiders call the Environmental Protection Agency, the EPA, the most powerful agency in the government. it can span into every arm of, of approvals, regulations. It's just a massive organization. So what he can't accomplish in legislation, he's going to try to push through regulation and executive order. So he can accomplish a lot there. And this isn't a social comment about, needing to take action on climate. I'm very much in that camp, but leaving that debate aside, the fact is that if you raise, regulatory requirements a lot, or just make it, harder to get approvals for new construction or new businesses or pipelines or whatever, it does have the net effect of raising costs on businesses. So again, it's not to say that environmental regulation shouldn't be done on a societal level, but it should weigh on the corporate sector to varying degrees, depending on the industry. I'm going to spin your question off a little bit, again, just on the regulation front as a headwind, that will have some impact probably on tech, other non-climate related industries, because the regulatory agenda under the Democratic Party in general, should ramp up compared to Trump, which was very light on that front. Actually, he had a policy that you had to reduce 2 regulations for every new one put on. I would, it's not going to be a policy, but I wouldn't be surprised to see the reverse under the Democratic Party. I mean, there is bipartisan support for, actions and things on technology. But just in general, the environmental side could really see a ramp up on business regulations, which could be a headwind, down the road as we look at once we get back to quote unquote normal times, taking a few tenths off GDP.
And I'm going to move this on now to, this is a very broad question, but I think this will really strike at the heart of what our listeners are going to be interested in. So what should UK and European corporates be hopeful and also worry about regarding what's in store from Biden? And I will start this off. There's been some focus, not an awful lot, on Biden's Made in America policy, which follows on from Trump's America First policy. So that's one element that maybe we can focus on. But anything else that you think corporates in the UK and Europe should be worried about?
Sure. Let me start there with the Buy America portion of his plan. I think this, dovetails nicely off of how I ended my last comment, which is that Biden is not a representation of a return to a free trade utopia. The same sort of protectionist overtones that Trump brought with him to the White House were really taken from, that we associate that with Trump, but that, that sort of skepticism of free trade tends to be much more common on the left than on the right. And I think that's very clear. So the specifics of the Buy America ideals is that we already actually have laws that require procurement, federal procurement, to be pushed in the direction of US made products. What Biden wants to do is not only increase the level of federal procurement, but he also wants to make it harder for companies to get waivers to American goods. So right now there's a waiver process where, if you can't source your goods from America, then you can pretty easily get a waiver and source it from a foreign country instead. And so Biden signed an executive order beginning the process of trying to tighten up those waivers where possible. The increases in federal procurement as a whole, that would require legislation. If you want to spend more money, you need to have Congress approve it. And clearly that'll be part of any sort of infrastructure bill that will be proposed. So clearly if an infrastructure bill, again, I think it's going to be tougher to get that bill done. But if it were, the government would have to source from companies that are sourcing from America, if that makes sense. I think from the perspective of US allies, there's already some talk that Canada's already trying to seek some carve-outs, as in, we don't want to be subject to this. It feels like it's a policy that's supposed to be aimed at China, but like a lot of trade policies that are this broad, it's going to end up hitting a wide array of our trading partners, including allies. So I believe Canada's already looking for carve-outs from this kind of thing. I would not be surprised if the EU and the UK are also kind of seeking that out. So over time, I think this will become, more important over time if you do get a big infrastructure bill and it turns out, hey, the government has to do a lot of procurement because they're doing a lot of extra spending on infrastructure. And with that, I think the scrutiny could get a little bit stronger. But I think it's worth remembering that these laws have existed. It's just that it had been easy to get exceptions to that. And so if those exceptions become a lot harder to get, then that might result in some companies, changing their sourcing away from, foreign products and towards American-made products.
So I'll jump in on the worries and things to be excited about or enthusiastic about. Broadly, I worry about the U.S. and China. I think the Wall Street Journal a month ago called Biden's first moves the most aggressive of any U.S. administration in recent memory. And it's not just economic ties. It was, sending warships through, near Taiwan and arms sales to Taiwan, supporting, having a Taiwanese ambassador at the inauguration, which is a hard signal to China. Human rights issues, Hong Kong issues. It's clear that there's a broad, rivalry. I don't want to go too far as the Athens versus Sparta here, but there is very much the old hegemon and the rising power. So I do worry that there are going to be even just non-economic trade flare-ups that could cause tensions and could cause some moves on, especially on the currency front in unexpected ways. Again, it's not policy by tweet, so it's not going to be like the last few years where Brian and I wake up every morning and have to check our Twitter feed before we check our market screens. So there's some reassurance in that, but that relationship is still a combative one in many ways. It's cooperatively combative, and it's going to be, there's tension in that. So that's one thing. Domestically, and this is just a long run trend, which I could probably apply to a lot of developed world and even developing world economies, which is, that of income and wealth equality. And I worry that domestic partisanship takes back over. We're already seeing partisanship, again, as Brian mentioned, that the Democratic Party is going to push the Republicans to the side in order to get these deals done. And that after that, we go back into, after these couple of bills, we head back into an policy morass where nothing gets done. Economic confidence in Washington falls even lower. And that could come at a time when the economy does need some more support down the road. But the general kind of underlying issues of wealth and income inequality, populism, driving parties to be either more left or more right. It's probably worth a whole nother webinar, but I think that everybody kind of has seen and felt the impact of that in their own constituencies and nations. And so that's something that just, I think, is kind of going to continue to boil under the surface, arguably been exacerbated by the pandemic and the rise in equity prices while, lower incomes are struggling still. So just kind of worry about some ongoing after effects of that just impacting the policy front. And then there's a good and a bad to, all these fiscal policies. The negative or the potential worry is about the amount of government supply that is going to be needed to finance these fiscal programs, because it's not being done with tax increases or anything. I mean, even today, look at gilt yields moving higher because of the budget, the amount of supply that's going to be down the road more than expected. The U.S. in part of the move higher in yields has been the kind of just the ongoing indigestion of some of the supply. So, is this a structurally much higher yield environment? No, but I do think that, that these bond markets are saying like, this is a lot coming, and we've, there's an adjustment process and a supply demand equation from Econ 101. You might just need higher yields to make that happen. Again, is this a 2% 10-year UK gilt? Is it a 1% German Bund? Is it a 3% US 10-year? No, not by any means. But I think that returning to the yields that we saw prevalent last year is going to be a challenge. But on the flip side of that, the enthusiastic side of it is that fiscal support is going to remain, I think, in all of these blocks for a long time. The UK, the US, we're seeing policies and actions now to varying degrees, but it's not post global financial crisis. After the 2008 crisis, we saw austerity setting in across many economies. Do I think that next year we're going to have as much fiscal spending as this year? Absolutely not. So the momentum is going to slow, but the underlying fiscal support for the economies is going to be much more supportive than it was in the past to get us out of this pandemic than it was. I'm sorry, much more supportive now than it was in the past in order to get us out of this pandemic. You're on the European side, even, there's the rescue funds will start hitting later this year. So, that horse is out of the barn, so there is going, that should get these economies moving more quickly. It should help us avoid that post-financial crisis, just slow grind back to health. So two sides to that coin. You might have some higher yields, but I do think that I'm quite optimistic for the end of this year and into next year in these economies, because the fiscal approach is very different this time around.
That's great. Thank you for those answers, both of you. Brian, I'm going to come to you finally with my pre-prepared questions, and this is specifically on currency. So this is the $1 million question. So sterling dollar and euro dollar have risen sharply since the pandemic, and both are now well above their pre-pandemic levels. Where do you see them heading over the remainder of this year and into 2022? And then specifically, what are the risks to these forecasts?
Great. So we've come into 2021 with a bearish dollar view, and we still hold that view, albeit the emphasis of that view has changed. In November and December of last year, it was looking like 2021 was going to be a year when global growth was expanding, and that the US relative to the rest of the world might continue to lag rather than lead that recovery. But the dawning of the vaccinations and the significant increase in vaccination rates, of the outperformance, I should say, in both the UK and the US in terms of their ability to vaccinate, combined with the fiscal impulse being a lot stronger coming out of the US because of the result of the January midterm special elections, giving the Democrats the Senate. That has led to an environment where the US is no longer seen as likely to lag a global improving recovery. It is more likely to be towards the leaders, especially early on in 2021. And so you have this interesting crossroads for the dollar, where it's a safe haven currency that tends to underperform during periods of strong global growth, but its own growth is likely to be quite strong relative to a number of major economies this year. And so you have this shade of US exceptionalism, maybe the dollar can outperform in that type of environment. And I think that's going to create choppy conditions from here. My personal opinion is that we continue to see dollar weakness, that the overall growth environment is so positive for global growth that's going to help the global growth linked economies more than it'll help the safe haven dollar. But we do have to contend with the fact that the US outlook is quite strong and has been improving. The beta, or the delta, I guess I should say, in terms of the improvement in expectations around the US has been very strong. So from the perspective of euro dollar, we've had a view that euro dollar would move to 125 in terms of top side. We still hold that view, but I feel more confident thinking that would happen later this year. Later this year, European vaccination rates, simply by the passage of time, will improve, and the fiscal impulse from Europe more likely to hit in the second half of this year, while the US fiscal impulse is hitting now. So I think the longer term outlook probably still positive for euro dollar, but I think it might take longer. That might be a second half of the year type of story. In terms of the overall range, if you're thinking about downside risks to euro dollar, if you do get a positive dollar scenario, whether that be because the Fed's tapering sooner, they're hiking sooner, the US growth outlook ends up dominating, European fiscal stimulus isn't going away simply because of that. And so getting back to 110, sort of the pre-European fiscal stimulus levels, I think would be difficult. So your downside probably the 110, 115 area. If your upside's the mid 120s. On the sterling front, we've been positive on sterling. It's a good story from a long-term perspective on Brexit. The resolution of Brexit-related risk, bringing back long-term thematic investment. I think that's generally been underweight the UK, and of course the vaccination rates have been very strong in the UK. So we've been long sterling. We favored it over Swiss franc rather than necessarily being long directly versus a dollar. But now we've sort of hit a bit of a sort of hit some resistance here around the 140 level. We do think you can get a move towards 145 if the dollar scenario does play out, if you do get further weakness in the dollar. And similarly, if the dollar were to turn a lot stronger and our base case was wrong, I don't think you're going to break back below the lows in the mid 130s. So that's kind of the ranges as I see it at the moment. I feel more confident in the UK story right now than I do about the Euro story. But that's something that might change over time as the timing of the fiscal impulse and vaccinations starts to shift in favor of the laggards compared to the leaders.
That's great. Now, just quickly follow up because you mentioned something that really resonated with me, and it's been a theme in the UK media over recent weeks, and that is investment in the UK now because assets are underpriced or viewed as underpriced, and is that going to be potentially another reason why sterling could remain at these elevated levels?
Well, I think it's certainly part of the story. When you think about whether it be sovereign wealth managers, been some discussion over whether or not there'd be diversification away from the dollars and into other currencies. Brexit has been, whether you're in favor of it or not in favor of it, whatever your political stance is, it has been a cloud of uncertainty, over this economy. And, that cloud has at least, abated. We're not spending each day thinking about, is there going to be a deal or no deal, which really feels like it was one of the main drivers, if not the main driver, of sterling expectations for the better part of 5 years now. And so that alone, I think, brings with it the possibility of longer term investment in the UK picking up. And so is that something that's going to drive, be a day-to-day driver of sterling higher? Probably not, but I think it's probably going to keep it more supported than certainly it was in the pre-Brexit, the pre-deal era, if that makes sense.
I hope you've enjoyed this episode of On Point. Please do subscribe to our channel to get future episodes and navigate to ci.natwest.com for the latest updates on what's moving markets. We also encourage you to follow us on social media to get all of our latest content. Speak to you again soon.